want to get to the state of the steel industry, but what is dominating in terms, like, thematically at the Industrials and Basic Materials Conference right now?
Yeah, that's a great question. Nice to be with you, Tim and Alex. We have the leadership teams of more than 100 companies and 400 or 500 investors all in one location this week. So we're excited to get started this evening. I think data centers and the Iran war will certainly be top of mind for a lot of people joining us. In steel specifically, I think we're probably more focused on pricing and this, frankly, very strange supply-demand backdrop.
Sam, one of the big debates right now is whether the AI boom creates this multi-year structural tailwind for steel for the build out of data centers. Do you think that at this point there is tangible demand, or is this just market enthusiasm?
Yeah, Alex, that's a good question. I think obviously data centers are dominating the headline, and steel is necessary for their construction. When you think about the construction needs in rebar, structural, data center specific applications like racking or airflow containment. But U.S. data center construction is expected to be about 80 million square feet this year. Every 1 million square feet of data construction requires about 14,000 tons of steel. So quick back of the envelope math, that's about over 1 million tons of steel that'll be required for data centers in 2026. And initially you might say, oh, wow, 1 million tons, that sounds like a lot. But the U.S. will probably produce around 90 million tons of steel this year. Wow. So 1 million tons out of 90, it's kind of a drop in the bucket at this point. So not yet a big driver of demand, but something obviously we want to stay aware of moving forward.
You say not yet. Does it ever become a bigger driver than 1 million?
Well, sure. I think, and I'm not a data center expert, Tim, but I think there will be more than 80 million square feet of construction next year and maybe more the year after that. So maybe it continues to grow. But as of now, data center steel demand is only about 1.5% of the U.S. steel market.
So where does the demand come from in the U.S. steel market?
Yeah, the demand in the U.S. steel market, I think you said it at the open, automotive, service centers, and construction are the big industries, and we can walk through that. But right now, I think it's more of a supply-driven story. If you look at supply right now, we track U.S. overall production on a weekly basis. The latest weekly production number we saw was the highest tonnage since March of 2020. And year-to-date production is up almost 8%. So given this fact, you would think that demand must be humming, or buyers are getting all the steel they need, and lead times might be coming down. But none of this is the case right now. I think buyers are pretty frustrated that they can't get the steel that they need from the mills.
Does the resilience of the steel market have to do with these favorable supply and demand dynamics, or are the fundamentals actually improving?
I think the supply-demand dynamics are playing a big part of it. Obviously, you and I can't go buy a 50,000-pound coil from the hardware store. You have to buy these steel coils in one of two ways from the mills. The major one is contract tons, weekly, monthly, quarterly agreements, and customers typically agree to the mills to buy within a minimum or maximum tonnage range. Right now, there's not a mill in the country that's allowing their customers to buy at the max end of that range. In fact, most of them are holding customers to the minimum end of that range, and that's true for a couple of months. This is pushing out lead times and really strengthening the pricing upcycle we've seen. The other way to buy steel is what's called spot tons. I order it now and you get it to me whenever it's ready. Those basically not available in the market at all right now. You saw U.S. Steel restart its Granite City furnace in Illinois back in late March, and that thing immediately booked out through like the end of July. So steel buyers trying to get what they can, but for now it remains to the advantage of these mills to keep showing discipline and keep the inventories lean, like you said, Tim.
Yeah, talk more about tariffs and the way that tariffs are affecting the U.S. steel industry and what imports are looking like.
Imports have always been a big watch point in this sector, but even more so since the Section 232 tariffs were raised to 50% almost a year ago. Last year, we saw steel imports down 10 or 15% year on year. There was a dramatic pullback in the second half of the year after the tariffs were instituted. And the tariffs continue to work this year to keep out foreign supply, which obviously makes the domestic steel makers happy. Steel imports this year are down almost 25% year to date.
Is there a difference between imported steel and U.S. made steel?
According to the administration, there certainly is. And according to the domestic steelmakers, there certainly is.
That's what I'm getting at. What do they say is?
Obviously, it protects American jobs. It protects our national security. There are a lot of reasons to use steel here, it's made here. But I think the one thing from the buyer's perspective that maybe doesn't get enough attention is right now the standard hot rolled lead time is about 7 weeks. It takes at least 3 months for me to get a cargo ship here into the country. So for the buyers, it makes a lot more sense still, even with the elevated price, because right now supply sort of trumps price. I think availability is top of mind for buyers right now. So the closer the steel it is, the more they're interested.
Sam, one thing that we talk about all the time is rising prices of electricity as a result of data center demand and data center construction. When we think about this from the steel production view, do rising electricity prices affect these steel producers, or is their energy source different? Is their energy source coal, for example, and they're not seeing it hit as hard?
Now, electricity is certainly a big portion of steel mill costs.
And is it increasing for them the way that it's increasing for consumers? Are they able to, how does that work and sort of how they're thinking about their own bottom lines and controlling for that cost?
So a lot of steel mills, Tim, hedge their electricity cost, or they have long-term fixed contracts. I think if we talk about inflation and maybe the Iran war more specifically, I think there are two main things to talk about with steel mills as it relates to the war. And steel stocks can sometimes behave as hedges against inflation, given that metal is a tangible asset whose price typically rises with inflation. Big inflation in March and April, and these stocks have done really well. I'm not an economist, but Tim and Alex, I don't think you guys know anybody either who thinks inflation's returning to 2% anytime soon. And the second, maybe more important than electricity right now, is oil. More specifically diesel, because domestically steel's transported by truck or rail. So think about when you're driving down the highway, you see the big coils on the semi trucks. That isn't a cheap freight route. And diesel prices have increased about 50% since the start of the Iran war. And that's a surcharge that mills typically pass on to customers, and that keeps prices high.
Sam, I'm going to switch gears a bit. Earlier this year, we were talking about how retail was aggressively trading in metals markets. Is that a phenomenon that's still happening?
Yeah, that's frankly not something that I can speak that well to from my current position. We don't speak with a lot of retail investors.
Are institutions heavily involved?
Yes.
Sam, I want to talk a little bit more about the industry and certainly automotive here. We're going to talk about Ferrari a little later, just kind of a fun little tease for our 407 segment about that new EV coming from Ferrari. Hannah Elliott's going to be joining us. The tariffs on U.S. tariffs on auto companies. The reason I say U.S. auto companies is because the auto industry is being hit with tariffs because the U.S. auto industry is global. I mean, Mexico and Canada in recent years have been a huge part of production. How does the auto industry, the supply chain of the auto industry, work for steel in terms of where it's transported and where it's actually where these cars and trucks are actually built? Because we know that Ford has suffered as a result of an outage at a steel facility in New York.
So if you talk about it from the steel perspective, you have Cleveland Cliffs in the Midwest, you have Steel Dynamics in the Midwest, and you have Nucor that kind of dominates the South, but they're building a big new mill in West Virginia right now. All of those companies supply to automotive. And then typically, Tim, to your point, they run through service centers who do the value added work, whether it's pickling, annealing, whatever you need to do for automotive. And then they ultimately ship it to the OEM. I think in the automotive market right now, it's sort of a dichotomy. Medium and heavy trucks and maybe the nicer vehicles, the demand there is still not that bad, kind of to your point earlier. But I think we've seen affordability and interest rates really weigh on the more economy class vehicles. And those can be bigger volume loads for the steel mills because you can typically churn out more cheaper cars. But
Sam, we had a strong earnings season for metals and basic materials companies. Can you tell us about some of your takeaways from the reporting cycle?
So we talked about the supply picture already, and I think it's probably important to talk about pricing next. The typical steel pricing upcycle usually lasts anywhere from 3 to 4 months. We are in the midst of a nearly 9-month march higher in steel pricing. We're up near $1,100 right now. We think it probably has a little bit longer to go. I was talking to somebody a few days ago who thinks we're going to get to 1,500 hot rolled coil. And in a normal year, steel pricing typically peaks in the late spring, early summer. But this year, I would look for the peak to happen maybe more in August or September, really expanding the gains that we saw in the first quarter that you pointed out, Alex. And so why is this happening, right? Why is this steel pricing cycle so long? Typically, when steel pricing rises, you can bet your mortgage that one of two things is going to happen. The first is that someone dumps a bunch of tons into the market to take advantage of the high prices, thus increasing supply and lowering the price. And the second thing that can happen is someone undercuts market pricing to secure themselves a bunch of volume.